he always said, don't stop the compounding, right? Don't do things in your portfolio that cause so much risk that then you panic and do the wrong thing at the wrong time. Because if you can just keep the compounding going, it's almost inevitable that you'll be successful. If somebody tells you they can get you, 15% a year with the risk of a bond, that's the attractive improbability, right? It sounds really great, but it's highly improbable that something like that would ever happen. What we do is, I always tell people, it's the less attractive, less sexy probability, right? It's if you build a diversified portfolio that is age and risk profile appropriate, if you stay disciplined with it, if you rebalance, if you use downturns in the market to buy low, it might not sound that attractive or sexy, but it is highly probable that over time you will accumulate wealth.
Welcome to Investing Insights, where we chat with experts from various industries to uncover investing and life lessons that empower everyday people like you. Today, we're exploring the modern roadmap to retirement planning with Jess Hurst. Before we dive in, a quick introduction to Jesse. He's the founder and CEO of Impel Wealth Management and a multi-year Forbes best-in-state wealth advisor with 38 years of experience. Jesse specializes in turning complex financial puzzles into clear, actionable visions. He's seen every market cycle since 1987 and is here to help us navigate the road ahead with clarity and confidence. This podcast episode is for financial education purposes only and does not constitute financial advice. Always consult a qualified professional for personalized guidance. Jess Hurst, thank you for joining us today at Investing Insights.
Yeah, thank you so much. I'm looking forward to our conversation.
Yes. Let's start with one analogy that you have shared with me in advance, which means if we look about retirement planning, you've compared it with a jigsaw puzzle. So there are many, many pieces, and there's different strategies to how to build a jigsaw puzzle. I just saw my family doing one a few weeks ago around the New Year's time. So please let me know, how can I, as a investor in my 30s, start to plan for my retirement?
Yeah, so it's interesting, and I know you and I talked in in our first conversation about my book, right? And so if you look at the cover of my Poponomics book that I just did, you'll see the puzzle pieces on the cover, and the 12 chapters of the book are written in a way that they're the 12 puzzle pieces that each person needs to put together to build their own successful retirement plan, the transition from work life to retirement life. And so if you just saw your family putting together a puzzle, right? I ask people all the time, I'm like, when you put together a puzzle, like when you were a kid, or if you were helping your children or grandchildren put together a puzzle, like what was the first thing you did when you started down that road? And people are very funny about like how particular they are about it. It's like, well, you got to turn over all the pieces so you can see you can see what's on them. You've got to find all the edge pieces, or you've got to find the four corner pieces and start there. And I always remind people that the first thing you got to do is you got to look at the box, right? You've got to look at the picture so you know what you're solving for. Because if you don't have that vision of what you're solving for, it's really hard to know where to start, like which piece goes where and so forth. You can't just visualize it. And I think the same thing is true with retirement planning, right? When you are planning for a successful transition from work life to retirement life, you have to have a vision for what that looks like. And the more specific that vision is, the more successful you're likely to be, right? I've had people say to me in the past, right? Someday I'd like to retire and I'd like to be, have a comfortable lifestyle. And that's kind of like, that's a nice wish. That's not a real goal, right? That's not specific, measurable, achievable, and so forth. And so, I tell people, hey, I want to retire when I'm 65. And I want to have my mortgage paid off, and I want to have income of $10,000 a month so that we can pursue the lifestyle we want to pursue. That's a goal. That's a vision that we can measure toward, and then we can start taking steps to achieve.
Okay, so if somebody feels unprepared for that, let's say, oh, I have a good, employment, I earn some money. But yeah, I don't really know how I should plan for retirement. I don't know when I will retire and how much money I will have then. What is usually your approach in helping people in getting there?
Yeah, I think two things that you have to think about. Number one is you have to know where you are, right? Where you're starting today. And again, from an analogy or visual standpoint, I always use the analogy of making a flight connection in a big airport, right? Like I was just over there in Europe for my 60th birthday back in October, and we had to make a connecting flight from Prague through Zurich, right? And you get off the plane in Zurich, and what's the first thing I ask people, what do you do? And it's like, usually they look for the concourse map, right? And then once they see the concourse map, they look for the thing that says you are here. Because if you don't know where you are, you can't figure out how to get to gate B37, right? Like you have to know where you are to start the path to where you want to go. So I think being able to, take an inventory of where you are, what your income resources are from work, what your employer benefits are, what your current assets are, current liabilities, whether it's your home, your mortgage, your 401k, your retirement savings, and so forth. Once you have a good feel for where you are, and you've got that goal from what we talked about first, right? That picture on the box of where you want to go, then we can start charting a way to get from point A to point B. And I find that probably one of the best ways to keep people motivated to stay on that path is to, you probably heard the expression, how do you eat an elephant, right? It's one bite at a time, right? You can't eat a whole elephant at once. And sometimes people look at it and go, well, I'm 35 or I'm 42 years old and I want to retire when I'm 65. And if I'm trying to accumulate $2 million to be able to retire comfortably, that seems huge. That's the elephant, right? But if you can help them start down the path of, hey, I'm going to make sure I'm taking advantage of my 401k plan and my company match, right? I'm going to, put an extra, whatever it is, 100 or $200 a month on my mortgage so I can pay it off in 22 years instead of 30 years, right? If you can help them make these little steps and they start seeing progress, then they start getting encouragement and want to keep taking additional steps.
Because sometimes it's difficult for our minds to think that much into the future, especially for me. Like I'm 30, nearly 35, and I'm like, well, how long more, how much more I have to work? Well, at least another, I don't know, 30 years, most likely more, 35. There's a lot of attitude and thinking as well. I will figure it out a lot. But what would be I cannot really tell you how much will be my spending. I don't know how the inflation will be. I don't know how long I will have to work. So how can I tackle that? How can I get unblocked in my mind?
I think again, casting a vision towards where you're going. So if you take a look at, and maybe I can just pull this up on a financial calculator while we're talking, right? If you said, if you said you're 35, that's a great example. Right? And I hate to say this, but my oldest son will be 35 in April. So, you take a look at it and say, okay, I'm starting off, and let's say you have $10,000 in your retirement plan. I think one of the things that people don't have a good feel for is how important the time value of money and compounding is over time, and how starting sooner makes massive differences over time. So if I put in here and said, I'm just making a very simplistic example, right? You put $10,000 in today, you add $5,000 a year to it, like in your 401k plan or something like that. And let's just say you earn a 7% rate of return, just a moderate rate of return, right? Well, if you did that for the next 35 years from now, just that amount grows to about $800,000. But if you waited 10 years to start the process because you say, I'll just figure it out at some point down the road or whatever, right? So if you did that for 25 years instead of 35 years, at 10 years of deposits, which is $50,000, right? 5,000 a year times 10 years. Sounds like it's a lot of money, but it's the compounding that really makes a difference, because by just doing that, it's 370,000 instead of 800,000, right? It's 430,000 more. It's 50,000 of deposits, right? But it's $380,000 of $370,000 of compounding that you miss along the way. So sometimes just something as simple as showing somebody what the difference it makes if you pay an extra $200 on your mortgage, or you start, 5, 7, 10 years earlier, what you will accumulate. I think even if they don't have that crystallized vision of what it looks like down the road, they can at least see, I'm going to be in this much better of a position by taking these steps today.
Okay. So the advice is at least start to put some money into something that compounds over time.
Yep. Yeah. Between that
Exchange
or,
and trade funds, ETF, in US is the 401.
yep, exactly. Any of those, right? I don't think, and I think if you do any of those in a reasonable, diversified portfolio that's age and risk profile appropriate, and I know here in the States, most of the big mutual fund companies, Fidelity, Vanguard, American funds, whatever, they all have what they call target date funds. I don't know if you're familiar with those. So they have those. And what it does is it takes, so if you're 35 years old, you go 30 years into the future, right? 30 years into the future would be around 2055, because they typically do them in 5-year age increments, right? So there's a 2035, a 2040, a 2050, right? And so forth. So you're supposed to pick the fund that most closely correlates to what age, the year that you would be turning age 65. And then what they do is they put together an asset allocation within those funds that says, okay, if I'm 30 years from retirement, I can be more aggressive. I can have more stocks and less bonds. And then as I get closer to retirement, there's a natural glide path where it says, okay, we're going to go from 80 or 85% stocks to 75 to 65 to 60 by the time we retire, so that people maintain the right risk profile without having to make adjustments all the time. So, like, there's vehicles out there that you don't have to be overly complex to deal with that. It's just taking the steps is probably even more important than whether you pick the 2055 fund from Fidelity or Vanguard or American funds. Just doing it is the biggest portion.
Got it. So what's your experience with retirement then happening? Let's say tomorrow I will retire. How do you see, do people start to spend more or less once they retire?
It's interesting, right? Because there's actually two sides to that. So the first is studies show, and I can tell you anecdotally, I just turned 60 and I've been doing this right out of college. So I've done this for 38 years, right? So I've watched this anecdotally with clients for decades now. And it would confirm what studies show, is that people tend to spend at their peak levels during their first 10 years of retirement, right? Which makes sense. They've got the gift of time, the gift of health, and hopefully, if they're clients of ours, we've helped them accumulate the gift of financial resources. And so when they're younger and healthier and have more time, they travel more, they eat out more, they play more golf, they pursue their hobbies, and so forth. Studies show that people during years 11 through 20 of retirement tend to spend at about 87, 88 cents on the dollar of what they spent during their first 10 years of retirement. And then if they're living years 21 through 30, they tend to spend at about 70 cents on the dollar from what they spent in the first 10 years, because as they get older, they just don't travel as much. It's harder to get around. Sometimes health and age limits that opportunity set. That's kind of the natural. So you've got two things fighting against each other, right? You've got inflation going up over time, which raises costs, but then you've got a kind of a natural spending digression that happens the other way as you age, until you get to really like end of life, last maybe 12, 24 months if you get into a long-term degenerative health situation. So you've got that dynamic going on. I think the second dynamic that's even more interesting, and something that we can directly impact by helping clients through coaching, and it's more mental emotional coaching than it is even financial coaching. If you think about your financial life in two kind of broad brushstrokes, right? You've got from the day you start working to the day you retire is this accumulation phase of life, right? I'm working, I'm saving, I no matter what I make, I spend less than what I make. I put the difference into my 401k or IRAs or investments, and I'm accumulating assets, right? And I'm paying down debt, and so forth, and hopefully making good financial decisions along the way. Well, the cumulative effect of good financial habits over long periods of time is you inevitably accumulate wealth. And then when you transition from that accumulation phase to the distribution phase of life, which starts the day you retire and lasts until the day you die, it's how do I use these assets that I've accumulated to create the income I want to have to do what's important in life. There's a lot of times that people have been so successful in this accumulation phase and the habits are so ingrained in them that they have a hard time flipping the switch and giving themselves permission to spend on the other side, right? It's kind of like built this because I saved and invested and was diligent for 40 years. And if I change my habits, I might not have this anymore. So helping people understand that that's why we kind of create a retirement income strategy for people and project this out so that up to a certain level, they feel comfortable and confident being able to spend those dollars. Because if not, a lot of times people will end up underspending what they could. I'll give you a great example. I had a client that was in to see me last week, right? And between both their social securities and his pension, they bring in about $6,500 a month, about $78,000 a year. They've got about $2.5 million of investment assets with me, which I don't know if have you ever heard of in the United States, one of the big things is the 4% rule, 4% withdrawal rule. It says studies show that if you retire and you take a 4% withdrawal from your investments and adjust that for inflation every year, that you can typically sustain that for a 30-year retirement without running out of your principal, right? So if you take $2.5 million at 4%, that's $100,000 a year. So between 100,000 from their investments and almost 80,000 of pension and social security, they could live very comfortably on $180,000 a year. They could do anything they want. I can't get them to spend money for anything, right? Because these habits are so ingrained in them. And I finally said to them, right, if 10 years from now, your 2.5 million has grown to, let's say, $3.4 million with minimal withdrawals, and we look back 10 years from now and you say, man, I wish we would have done this, or I wish we'd have taken that trip, or what, I said, we failed, right? I'd much rather see your 2.5 million 10 years from now be 2.9 million and have you guys say, we had a blast. We did everything we wanted to do. We created shared memories and experiences with our kids and grandkids, and like helping people kind of cast that vision. And probably the best comment I got from a client who I finally got over the hump to be able to kind of break that mindset, because they have two children. One's a pharmacist, one's an engineer. They make lots of money. The kids will be fine if they inherit something, but the kids don't need their money. The mom and dad who've been clients of mine for more than 30 years, they're almost 70 years old now, and they finally decided to take a trip to Australia and New Zealand, and they're going to fly first class. And I'm like, I've never been able to get them to spend money like that. And I finally said, like, what made you decide to do this? And they said, well, we kept hearing you say it's okay to spend money. We have it and so forth. And then the wife said to me, she goes, it finally hit us that if we don't use our money to fly first class, eventually our kids and grandkids will.
Well, yeah. One day, somebody will take over all of that
Yep.
legacy, and will
Yep.
have to manage all of that money.
Yeah.
Yeah, it's interesting to hear that. I mean, I see as well, people really have to actively start to invest, save, because just to give an example, in Germany, usually if you retire, let's say you have an income, which is quite a high income nowadays, of 5,000 euro net
Okay.
end of the month, and let's say you retire next week, then actually what you will get from the state is just about 50% of your last salary. So you actually have to, if you have a good lifestyle, so you have a house to maintain with a pool, I have maybe 2 cars, I like to travel and go skiing in Austria, then you have to live with half of your money from one day to another, which is actually not ideal, which actually forces you into, okay, I have to continue to work, which a lot of people are used to. What you've mentioned, I'm just used to, I need to still work, I want to work, I want to feel like I need to do something. And the other reason is as well as maybe they haven't saved enough. So
Yeah.
that's
And
actually.
To exactly to your point, one of the things we always look at with clients is, let's say, use that example, right? €5,000, you get half of that or €2,500 from your government pension. That means you need to save enough in other resources to replicate the other 2,500 you're not going to get. So we always look at it and go, when you retire, what are the income resources you're going to have, which is the government pension? And then to make up the difference, we have to create asset resources to fill the gap, right? And so then you have to target towards that.
Yeah, because you're swapping out your payslip for something else. So can you give us an example what could be such income generating assets?
Yeah, so we tend to have broadly diversified kind of institutional portfolios similar to what you would see in a pension fund or a college endowment fund, right? We tend to, I would say the vast majority of our clients tend to be somewhere between 50% and 75% stocks, depending on what their risk profile is and how long until they retire. And then again, some of it comes down to, how much surplus do they have? Sometimes they'll leave some of those surplus assets that they don't think they're going to need invested more aggressively so that portion can grow and become an inheritance to their kids and grandkids, right? But so as you take a look at it, if you were to look at a 60% stock kind of target portfolio for us, it would probably be about 40% US stocks, split kind of equally between value dividend stocks and more growth stocks, with some mid cap and small cap in there. It would probably be about 20% international, developed international, and emerging market stocks. So developed would be like Europe, Japan, Great Britain, that kind of stuff. And then the emerging market stocks being more maybe Middle European, South and Central America, Southeast Asia, and so forth. And then the other 40%, and this is where there's been probably a little more evolution over the last 5 years in our portfolio. And that 40% that would typically be in bonds, we've kind of evolved that to where it's probably more like 25% bonds and the other 15% we're using bond like alternative strategies, things like merger arbitrage funds, market neutral funds, things that give you bond like return and bond like risk characteristics, but also don't have the same interest rate and inflation risk. Because when we went through post COVID, right, we went through this period where inflation in the United States went from years and years where it was under 2%. All of a sudden, inflation in 2022 and 23 shot up 0.1%. And then the Fed had to start raising interest rates aggressively. Well, when the Fed raises interest rates, bond prices go down. So if you have 40% of your money just sitting in bonds, you're going to get clocked on you're going to get hurt on the other side of that. So we started making adjustments on that side. And we typically target a dividend yield out of our portfolios of somewhere in the neighborhood of 3.5 to 4%. So that, if we're taking a 4% withdrawal rate from our portfolio, we can fund most of that from the dividend side of the portfolio without having, and that dividend is a combination, or that distribution rate is a combination of dividends from the stocks and interest on the bonds.
Okay, so you make sure the portfolio still grows and that this 4% that somebody plans to take out in their retirement is then actually funded by those dividend paying stocks or
Exactly.
income generating assets. Do you see in general that bonds get a bit less interesting? I mean, it's for centuries it's been uh, yeah, a key pillar of most portfolios. But nowadays, with so many new products coming up, new asset classes, do you see in general there's a trend towards like using less bonds?
Well, yeah, and like I said, I like in our scenario, we're using less bonds than we did before because of some of those alternative strategies. And it's bizarre because, like, and again, having done this since I started in the business in 1987, in August of 1987, in October of 1987, we had a stock market crash. It's actually the biggest one-day stock market crash in the history of the United States. So that happened 6 weeks after I started in the business. And since that time, right, I've also lived through two Persian Gulf Wars and dot-com 9/11. I've lived through the 07, 08 financial crisis and so forth. And I think one of the big things that we've seen in the last 5 years that's really different from what we saw, let's say, during the dot-com 9/11 scenario, the 07, 08 financial crisis, or the COVID crisis. In each of those scenarios, when the economy slowed and the stock market fell, the first thing the Federal Reserve Bank and other central banks around the world, right, whether it was Bank of Japan, European Central Bank, Bank of England, or whatever, did was the economy slowed, the stock market dropped, and the central banks cut interest rates to try to support the economy and stimulate growth and spending. So when interest rates went down, bond prices went up. So that was 60% stock, 40% bond, and stocks dropped. If the Fed or the European Central Bank cut interest rates, bonds went up. And so, at least something in your portfolio was doing well. Post COVID, right? We get into 2022, 23. In 2022, the US stock market from January 3rd to October 12th dropped 26% when Russia invaded Ukraine. And then the Federal Reserve Bank started raising interest rates dramatically. But it was the first time since the late 70s, early 80s that at the same time the stock market was dropping, the Fed was raising interest rates. So stocks were going down at the same time bonds were going down, and nothing helped. And that's why some of these alternative strategies have become more attractive in a higher interest rate, higher inflation post COVID world.
Got it. Okay. Yeah. That's really what we have to understand. This whole mix of like how the
Yeah.
Fed
And I
is
mean, like, I can
reacting.
go as deep as you want on any of that, right? But like, it's been a big philosophical shift that I hadn't seen in my first 30 years in the business.
Yeah. I mean, what I'm looking at as well, again, it's me, the target group being 35 and thinking like, okay, when is it time to put money into income generating assets instead of growth stocks, for example? Because right now I don't really need this passive income because I have my job, I have income streams. But so what do you usually recommend if somebody's younger? When should they actually move to something that conservative as
Yeah,
bonds?
so typically, kind of like those target date funds we talked about before that have kind of that natural glide path, we see something very similar. So you take my two sons who will be 35 and 33 in April, right? I would expect that they would have 85, 90%, maybe even 100% of their assets in growth or alternative type assets, stocks or alternative type assets. And it's exactly like you said, right? They don't need bonds for income purposes. The only reason they would really need any bonds in their portfolio would be for risk mitigation purposes, right? Because typically, and we saw this last year, you know how I said in 22, the stock market dropped and the bond market dropped at the same time because the Fed was raising interest rates. Well, over the last, from September of, I'm going to think through this, from September of 24 through the end of 25, the Fed's cut interest rates 6 times by 1.75%. So last March, April, when we went through all the trade tariff, dislocation and volatility related to, President Trump coming out with the Liberation Day announcements and so forth, and the stock market dropped 20%. Well, because the Fed had cut interest rates, bonds actually went up in value. So bonds kind of did what they did back in the dot-com 9/11 scenario or 07, 08. So they played a role in mitigating risk, but you only need, for if you're a young person like you or my sons or whatever, right? You really only need enough money in bonds to mitigate risk to the point that you stay put, that you don't panic and sell when things are down, right? Because that's the other big problem is, when the stock market dropped 20% last March, April, in early April, people were panicked and sure that this trade war was going to do a number of things, right? It was going to slow the economy. It was going to cause a recession. It was going to cause corporate profits to crater. It was going to cause job loss and so forth. None of which came true, by the way, right? But if people felt enough pain in their portfolio that they panicked and did the wrong thing, they missed this massive rebound that occurred from early April through the end of the year. And so the only reason, going back to your original question, the only real reason to have some bonds in your portfolio would be to mitigate risk enough that you don't panic and do the wrong thing at the wrong time.
Save yourself from yourself panicking.
Yeah, no question. And I mean, Warren Buffett one time said, he said, an investor's chief enemy is likely to be himself, meaning that he's probably going to do the wrong thing at the wrong time sometime just because they panic, right? I love Warren Buffett has lots and lots of great quotes through all the years, right? And one of the things he's fond of saying is that Americans are known as consumers, right? They buy stuff all the time. Even when sentiment surveys, I don't know whether you pay any attention to this, but in the United States, we have two big consumer sentiment surveys. And even when the consumer sentiment surveys are down and people say they feel lousy about the economy, retail sales still grow because people, regardless of what they say, they still spend. So Warren Buffett likes to say that, Americans love to buy everything they can on sale except their financial assets, right? When the stock market drops, right? Think about it this way. If you had a stock that was at $100 a share and you were willing to buy it there and the stock price dropped to $80 a share, people panic and they either go, I want to sell that, or they don't buy more. And Warren Buffett's like, hey, if you were comfortable buying it here and the price drops 20%, you should be loading up the truck and buying all you could while it's on sale. But people don't generally do that.
Yeah, it's interesting. I mean, for me as well, like, of course, my portfolio dropped heavily last year, but then I looked at all asset classes and all of them were down. So I was like, okay, it doesn't look like I was just too heavily invested in stocks. It just like the whole market across all asset classes was down. The only mistake I really did or had was I didn't have a margin account. I had a cash account, my broker, and I was not aware of the power of, for example, using in that amount because I didn't have that much cash flow to load up.
Yeah.
So I actually learned about that later that, hey, actually you can borrow from your broker, use a bit of margin, and then actually load up and buy more of what you will know will go back up, for
Yeah, right.
example,
Because
which
I would, I
6 months
would, I
later.
would assume, I would assume that based on what dropped in March and April, you did really well the rest of the year, and things finished the year much better for you than where you were when things were down so much in March and April,
Hmm.
right? And it's interesting from that standpoint. I remind clients that, hey, in early April, you felt really nervous about what was going to go on in the markets because of all the things we just talked about. And then over the next 6, 7, 8 months, we still had continued trade tariff uncertainty. You still had uncertainty around the path of inflation and what the Federal Reserve Bank was going to do. You still had fears about GDP growth and economic growth and recession fears. In the middle of all of that, the United States managed to drop a few bombs on Iran's nuclear facility. So you throw geopolitical risk in there. And if you had said all those things would continue to happen, most people would never have thought that the stock market would rebound 25 or 30%, right?
Hmm.
But it did, right? And that's why I tell people, don't invest emotionally. Just be systematic, stay disciplined with your diversification, which means, right, if you have a portfolio that's 75% stocks and 25% bonds, just as an example, if stocks drop and the Fed cuts interest rates and bonds go up, well, you can sell bonds high, buy stocks low, rebalance back to 75-25, and all you're doing is selling this high to buy this low, and you'll benefit from it. Stay disciplined with that process. Don't let your emotions get in the way of your success.
Hi, my name is Georg, and I'm the host of Investing Insights. I would love if you could click below on subscribe because it will help to make our podcast grow and invite even more interesting people to our show. So thanks for your support and enjoy the rest of the show. Great. I mean, the basic principles of investing, they will not change. They will continue to remain those rules about the emotional resilience and knowing what you do and follow your vision. But I would still like to hear from you how do you think portfolios should evolve over the next years? I mean, we are getting into our life is getting more dynamic. There's new companies coming up with the revolution of AI. We have so much more innovation hitting us in all industries. What are some trends that you see that we should look at, something how we should structure our portfolios to be resilient, how it's always called, to invest in something that can stay for many years so this compound effect works. But yeah, if everything is so dynamic, what is it and what can it be?
Yeah, and there are charts out there. I wish I had one here because I'd show it to you that show over time different asset classes go through peaks and valleys and so forth, right? If you go back to the late 90s, we went through about 5 years of the dot-com bubble where anything that was technology or had dot-com attached to it compounded at like 20 or 25% a year, 5 years in a row. And other things that were much more, let's say, lower risk, more quality earnings, more value or dividend related, didn't do so well during that time period. And you'd have clients that would look at you and go, you know, these quality dividend value things aren't doing well, but all of my .com AI or .com tech stuff is doing great. Shouldn't I sell this and buy more of this? And I'd say, so what you're telling me you'd like to do is sell this low to buy this high. And then I'd just shut up and let them think about that for a while. And then they go, well, maybe that doesn't sound like the right thing to do. But the tough thing was during that 5 year time period is, if I told them that in 97 or 98, the next year, the same thing happened. The tech and .com stuff had another great year and these quality things did awful. And people would come back in and they'd go, well, if we'd just done what I wanted to do, right, it would have done great. And it was a long time, but then in 2000, 2001, 2002, it all flipped. All of these tech and .com things dropped like a rock 3 years in a row, 20, 25, 30%, while all of these value, quality, dividend type things shot up. And it wasn't like these things were bad and then all of a sudden they were good. They were just out of favor. And so that's why I think finding an asset allocation that is age and risk profile appropriate, rebalancing regularly, which sounds boring, right? But it works. And then staying disciplined with that so that you don't make emotional decisions. I know we were focusing more on the younger people, but for most of my retired clients, one of the big things that we do to help them not make emotional decisions is we take upturns in the market, right? We make money by buying low and selling high. So if you take from April last year through the end of the year, the market rebounded 20, 25, 30%, depending on what sectors you were invested in. So what we do for our clients who are withdrawing 4% a year is we use a big upturn like that to trim some of their positions, 1, 2% of it, move it into things like short-term bonds that are yielding 4, 4.5, 5%, but don't have market risk and volatility. And we generally try to keep those clients 2 to 3 years ahead in their liquidity needs. So use an example. Let's say I have a client with $1 million portfolio, and let's say they're taking out $40,000 a year from that 4%. We'll try to keep them where we've got maybe $80,000 of the portfolio sitting in things. We'll strategically use those upticks in the market, sell a little bit high, put things in lower risk assets, and then have dividends pay in cash so that not if, when the next downturn happens, right? I've done this for 38 years. I've been through, I think the last time I counted, it was 21 different significant downturns that were related either to financial crises, geopolitical issues, or health pandemics, right? It's not just COVID. We've been through SARS and we've been through swine flu and we've been through these before. And you've got to have a strategy to get through those. So I had a client who, I'll share this story with you really briefly and then move on from there. But I had a client who in the United States, you have to take minimum distributions from your retirement accounts once you hit a certain age. And this client in 2022 was hitting that age where he had to take his first required minimum distribution. And he was supposed to come in and see me in November, and he was scheduled to come in and see me in November. He called me in October and he said, Jesse, Russia invaded Ukraine, the Fed's raising interest rates, stocks are down, bonds are down, and I have to take this distribution. What do you think I should do? And I said, well, last December when the stock market was at all-time highs, we sold a little bit high. We put that money aside and we have enough money sitting in low risk assets to cover your required minimum distributions for 2022, 23, and 20, and with dividends 24. So we don't have to worry about what the headline in the news is today. So what I think you should do is probably turn off the TV and go play some golf or go hang out with your grandkids, right? And he was like, that sounds like a perfect idea, right? But you've got to have a strategy for managing that liquidity liquidity plays right into resilience, right? That's what helps people not panic and do the wrong thing at the wrong time.
Yeah, as a younger investor, we still have to learn that we should be patient and that knowing as well prices go down. Happened to me too often that I bought actually a stock too expensive.
Yeah.
Just for like knowing, yeah, it might go up still more, but I just want to be in there already.
Yeah.
And it doesn't make sense. You
Well,
have to just
one
have
of
to
the
wait.
best things I ever saw, and I'll keep this real brief, but back in 1987, when I was brand new to the business, I'm 22 years old, right? One of the best presentations I ever saw, and I still use it every once in a while with clients, is if you take a look at a long-term chart of the stock market, right? 50, 70, 80 years of performance. They said it's like watching somebody walking up a hill bouncing a yo-yo, right? It says like the yo-yo is the year-to-year volatility, but if you look at the long-term trend of the market, it's actually relatively stable. And they said, if you want to be a long-term successful investor, watch the hill, not the yo-yo, right? You just got to pay attention to what that long-term trend is. And then if you're going to watch the yo-yo at all, watch it so that when it's in a downturn, you can buy low.
Do clients actually come to you with ideas as well? Let's say, I know right now it's quite famous that MicroStrategy is a company that buys a lot of Bitcoin. And then on top of that, they develop new financial products. So they have, for example, their Stretch product, which pays you 11.5% dividend. I think they announced that a few days ago. Is that something, I mean, because still it's Bitcoin based and it's based on a company giving out these dividends, that's actually high risk. But do clients come to you with such ideas and how do you react to it? Allow it for them to say, okay, let's put this in your portfolio if you want it, or what's your
Yeah.
opinion on such things?
Yeah. So a couple of things there. One is in the United States, the regulatory environment around allowing those kind of investments in portfolios is much more restrictive. So a couple things. So most of my clients, right? I've got two other certified financial planners that work with me. I told you I just turned 60. I have a financial planner who's 52. I have another certified financial planner who's 41. They tend to have younger clients than I do. Most of my clients come to me when they're in their late 40s, early mid 50s. They're trying to figure out if they can retire successfully. And then once they retire, they tend to stay clients of mine throughout the rest of their life. So I have a lot of clients the bulk of my clients are 55 to 85 years old. So most of them are not coming to me with, hey, I want to buy Bitcoin or some alternative high risk asset. They're just trying to figure out how do I create the income I need and minimize risk. Now, some of our younger clients who are, let's say, in their mid to late 30s, early mid 50s, who are still firmly on that accumulation phase of life, they tend to be the ones that come to us more with those types of ideas. And if it's a product that the regulatory environment allows us to use, then we're willing to do it if they sign off that it's their idea, that they understand the risk associated to it, and then we'll try to size it in the portfolio. It's a weird dynamic, right? You want to size the position so that if it does well, it actually makes a positive difference in the portfolio, but you don't want it so large that if it doesn't do well, they get hurt in the process. Usually somewhere between 2 and 5% of a portfolio. You don't want to be risking too much on something like that. But you want to risk enough that if it does well, it actually, makes a big positive impact for you. I'll give you a great example. I had never bought gold in client portfolios ever, right? And there's lots of reasons why. It doesn't pay a dividend, there's no earnings, it's hard to value and so forth. Based on what was accumulating in government debts and based on global debt around the world. If you take a look at the debt of Europe, of the United States, of Japan, of China, and so forth. And based on the fact that central banks who were nervous about holding too many dollars were starting to buy more gold. November of 2019, we bought a 3% position in gold in our client portfolios when gold was 1470 an ounce. And today gold's, just under $5,000 an ounce. That's a position that we took that we had never done before. It was an alternative position, but it really has helped our client portfolios. And we didn't take a 10% position in it, but we didn't take a 1% position. We took a position that was meaningful enough that it would do what we wanted it to do if gold moved.
Amazing. You spotted it early on. I mean, now I see it on feeds popping up, people saying buy silver, buy gold, and that's like
Yeah, yeah.
very, very late in the game. Just going back to that MicroStrategy example, I mean, for young people, it sounds interesting. It's like, wow, I can get 11% return on something. How do you see it as an expert? Is it risky? I mean, they bought so much Bitcoin, they have a lot of liquidity, so it sounds safe, but a company can always go south.
Yeah, yeah. I'm not familiar with that particular strategy, but if you look at capital market assumptions over long periods of time, stocks average over long periods of time, 50, 60, 80 years, around 10 to 11% a year is a historical average. Smaller company stocks, maybe a percent or two higher than that, 11, 12. Bonds have historically averaged 4 to 5%, and so forth. So if you find something that is projecting an 11% or better return, there's no risk free, there's no free lunch, right? There's no risk free returns. So if it's pricing a return that's similar to the stock market, you would expect that it would have a risk or standard deviation similar to that. And you would probably want to allocate or size that position accordingly in your portfolio, right? And, especially if it's a new strategy and it's not tested yet, I'd probably be more on the smaller, cautious side of taking that. One of the biggest things, I don't know if you've ever heard of a guy by the name of Charlie Munger. Charlie Munger was Warren Buffett's business partner who passed away last year at 99 years old. And one of the biggest things he said was he always said, don't stop the compounding, right? So it goes back to what we were talking about before. Don't do things in your portfolio that cause so much risk that then you panic and do the wrong thing at the wrong time. Because if you can just keep the compounding going, it's almost inevitable that you'll be successful. And that's whether you earn, now you'll be more successful if you earn, 10% a year than if you earn seven. But on the other hand, if you earn 7 or 8% a year, you'll still compound and grow and build assets and wealth over time. And I think that's the most important thing than trying to, if somebody tells you they can get you, 15% a year with the risk of a bond, I would sit there and say, I tell people that's the attractive improbability, right? It sounds really great, but it's highly improbable that something like that would ever happen. What we do is I always tell people it's the less attractive, less sexy probability, right? It's if you build a diversified port that is age and risk profile appropriate, if you stay disciplined with it, if you rebalance, if you use downturns in the market to buy low, it might not sound that attractive or sexy, but it is highly probable that over time you will accumulate wealth. It just happens. I've watched it for decades.
Yeah, I'm invested in an ETF for on the Nasdaq 100,
Yeah.
and I had a look and I was like looking for which stock to pick and what's the next one that can maybe make like 20, 30, 40% next year. And then I had a look and actually in the last years, in average, just this ETF made 22%. So I was like, actually, that's like much better than thinking, okay, which stock will now be the right one if they're already in there, anyways.
Well, and one of the things that I'm looking at right now is if you look at the last 6 months, right? I don't know which one you're in. There's a NASDAQ 100 trust that's run here in the United States called the ticker symbols QQQ. It's same thing, right? And if you look at that fund, it's gone up, I think on average over the last 5 years, like almost 30% a year. The only other time it's done that was in the 5 years through the dot-com bubble in the late 90s. And then that ended not so great over the next 5 years, right? So what we try to do also is say, if something, have you ever heard of it? In the United States, we call it reversion to the mean, mean reversion. I don't know if you've ever heard this term. It basically says if an asset class averages, use this example, let's just say an asset class averages 12% a year over time. If it goes through a period of time where it outperforms that mean rate of return by a significant amount, at some point, it will go through a period of time where it underperforms that mean rate of return because the average of all the highs and lows brings you back to the mean, right? So if you go through a 5-year period where this NASDAQ 100 thing outperforms its mean rate of return, might be a good time to consider trimming some of your winnings and looking for something that's underperformed that you can buy cheap. And there's lots of things out there that you can do. You know, we have a mutual fund that we buy that I won't mention the name of it, but it buys dividend based US and international. It's actually about 65-70% international dividend stocks and about a third US dividend stocks. And where the rest of the market is trading at a PE ratio, in the United States, PE ratio on the S&P 500 is about 22. If you go to the tech or like NASDAQ 100, you're talking about PE ratios closer to 30. This is paying a dividend of like 4.5, 5%, and it's trading at a PE ratio of 13, right? So it's cheap, it's paying a dividend. And last year it was up 35%. And so it rivaled what much riskier investments did with a much lower risk profile. I'll take that all day long, right? Like,
Hmm.
there's a guy, a wealth manager who runs a big financial investment firm here named Richard Bernstein, RBA Investors, Richard Bernstein Advisors. And he put out an article recently that said, buy what's unloved or unbeautiful, right? Buy things that nobody's paying attention to that are cheap, because the things that have done really so well over the last 5 years, they don't like, the human brain tends to take presently observed patterns and extrapolate them indefinitely into the future. And that's not the way financial markets generally work. You know, it's just for food for thought. I'm always happy when people do well, but I don't want people to be so tied to that they write it up and then they write it down.
Yeah, and just because it went up doesn't mean it will continue to go up. So I get your point. Like maybe not loading up on it, maybe trimming. And if you say don't, if you don't trim, at least don't load up when it's
Really high.
um expensive. Yeah,
Yep.
yeah. That's actually one of the challenges as well. Is like finding what is the alternative to this investment. What's out there? What's the right one to take? Because of course we have such an abundance now, and with all our brokerage apps, we can buy anything around the world basically. Uh,
Well, and that's
Not
a great point,
24/7,
right?
but Monday, Friday.
Just because you can buy anything doesn't mean you should buy anything, right? You got to find what makes sense.
Jesse, if people want to work with you, what's like the minimum amount that somebody needs to have to be able to enjoy your services?
Yeah, I generally don't work with any new clients under $1 million of investment assets. Now, my two other younger financial advisors in our firm who follow the same process, you know, it's generally $250,000. We actually have a next gen financial planning service that is more subscription based, monthly subscription fee based, that has a much lower minimum to help kind of the people who are like 25 to 45 years old. So you can access those services through our firm. But, you know, I've done this for 38 years. I've got about 140 clients and about $320 million of investment assets that I manage for those clients. I'm at a point where I'm pretty selective about new people that I take on, but our firm, Impel Wealth Management, which is where you can find us, impelwealth.com. You can find me on LinkedIn, Jesse Hurst, you know, on LinkedIn. I write a couple blog posts a week. So I've got like 7,500 people that follow my blog posts and writings and so forth. And then we do a lot of video content out there on YouTube as well.
Mm.
So you can find us any of those places. And the book, you know, Poponomics, you can find on Amazon. So it was a lot of fun. Like, I don't know, I don't think we talked, I think you and I talked about this in the pre-recording. Almost all the book and the blog posts that I write, I always try to frame whatever topic we're talking about through the lens of some classic rock song, movie, TV show, Broadway show, to try to make it fun and relatable for people. So it's not just a dry, boring numbers and charts based, financial, writings.
Yeah, it's cool, and I can see it's not just a blog post where you get a I don't know, a catchy tune or a catchy headline and then just write something. I see it has some depth. Like you really have data in there, analysis, like explaining what's the market doing. It's a really great resource. I read a few and it's really good. So
Thank you.
yeah. So I've heard a lot of financial advice from you, really great inputs. I've learned a lot. So but now I would like to learn more life hacks from you. So let me know, how has failure set you up for later success?
I think failure for me personally drives me for future success, right? I want to overcome what I did, learn from my mistakes, get better, and so forth. And I mean, I hate to say this as a little kid, but I played on a baseball team where we were the second best team in the league, like 6 years in a row. And the team that won first place won the state championship and all that stuff. So I have all these second place trophies, right? Never a first place trophy, but I was kind of like, every year we're going to get better and so forth, right? And you learn through your mistakes, and the goal is not to make those mistakes again, but just to continue to try to learn from those and get better at what you do.
In the past 4 years, what new belief, behavior, or habit has most improved your life?
I think the two things I would say is, one is I've really, and I've thought this for years, but I've crystallized it more in my head over the last 4 or 5 years, is number one, money is a means, not an end, right? It's not like whoever dies with the most wins. So what are we accumulating these resources for that make a difference in your life? So that's number one. And then the other thing I would say is the adoption of AI tools, right? Like we're doing things with AI in our portfolios. We're using them in our technology systems and stuff, to the point where our firm has about doubled in size in the last 4 years. And we haven't had to add any more team members to do that because we're working that much more efficiently.
That's impressive. I mean, the first learning ties into being second. I mean, in finance, you don't need to be the first. You need to be the richest person in the world. It's fine if you do really good, and you don't need to be
Well, it's funny
the
because one of
number
the
one.
questions we ask clients all the time is, we'll run these projections and they'll say, okay, if you retire at age 64, you might have this much money at age 90, to life expectancy. If you work 2 more years to age 66, you'll have more money at age 90, but does it really matter, right? If you retiring at 64 gives you enough money to do everything you want to do the rest of your life, sometimes enough is better than more. You don't need to work 2 more years if you've got enough already, right? But just helping people frame those conversations is really important.
What is one of the best investments you've ever made?
I would say by far the best investment I ever made is education. Education and continual life learning. We talk about, in our office, we talk about being students of the business, right? I generally read 600 to 800 pages a month of economic and political commentary. I've done it every month for 38 years. And so you can have confidence in how you're guiding clients. And for me, it's not just what you've read. I've also lived with clients through two Persian Gulf Wars and the .com 9/11 scenario and so forth. So it's the combination of all the reading and education along with the real life experiences. And then I would say the other great investment for me is just being willing to take the risk, the entrepreneurial risk, to start my own business, right? And build a business that has substantial value beyond just my retirement accounts, my investment accounts, and my home. Having an investment like that, where you were willing to take the risk and build a business that has enterprise value, has been the best thing.
Beautiful. What advice would you give to a fresh investor about to enter the financial world? And what advice should they ignore?
Yeah, I would say the best advice would be to start early, start small. Don't think you got to do it all at once, and celebrate small wins. Take these small wins and use them to compound to future success. The biggest thing I would say to avoid is just don't get caught up with like long-term financial guidelines for building wealth haven't changed that much. A lot of times small, newer, younger investors get really caught up in that idea we just talked about, the sexy improbability, this attractive thing. And if I put money here, I could hit this massive home run, but I might strike out also. It's like I'd much rather see people compound and grow regularly than swing for the fences and then maybe strike out in the process, right? So just celebrate the small wins and don't get overly captivated by something that sounds too good to be true.
Finally, who should I invite next to this podcast? Or what should our listeners hear about?
Yeah, well, I'll tell you what, if you want to have somebody who's like in our world, but wrote a really good book on a different topic, my one of my good friends and business partners who lives in another part of the country from me is a guy by the name of Pete Bush. I can introduce you to him. He wrote a book called The Runway Decade a couple of years ago. And the idea behind the book is when you get into your 50s, right? You've got about 10 years of runway left before you take off into your retirement journey. And what are the things you need to do in those last 10 years before you retire to make to create a successful retirement for yourself? He's a great guy, great speaker, really fun guy. And he also played baseball for Louisiana State and played with he's got a number of professional baseball players that are clients of his. So he's dealt with people, professional sports athletes who sometimes bring different resources and challenges. He tells great stories. You'd have fun with him.
Thank you, Jesse. That was amazing. I've learned so much today. Thank you so much. We will link out in the show notes to your website, to your blog, especially. Great place of education, as mentioned.
Thank you. It was fun. An hour went by fast.
If you enjoyed this episode and would like to learn how to invest, check out our website, learn.investling.org. We have a free course called Investing Essentials, where you will learn all the basics about investing. And best of all, you will get access to a free AI mentor who guides you throughout the whole course and will help you to take your first investments.